Thank you very much. So I just wanted to provide a bit of a international perspective on the question of deductibility and also taxability of intragroup payments. And it's probably obvious, but this is a fundamental issue in international taxation, because for multinational enterprises, these payments between related parties are a fundamental part of the way that they run their businesses. So the success of large multinationals is based on the fact that they have complex, highly integrated global value chains, supported these days by modern technology that enable them to operate in multiple jurisdictions. And consequently, the share of international trade that represents transactions between related parties has grown dramatically in recent years. So it is probably the majority by value. So in a sense, that's all perfectly innocent and part of the success of these large enterprises, but it has also provided them with an opportunity to reduce their tax liabilities, typically by ensuring that profits are recognized in low tax entities or places where the group is enjoying tax benefits, tax holidays. For many years, this has been a priority area for tax administrations in terms of regulating the level at which their tax base is being eroded by intragroup payments. And some are particularly problematic. Interest, because it is so simple to arrange an intragroup loan. It takes a matter of moments to put the paperwork in place and to execute the transaction. The second most problematic area has been the payment of royalties for intellectual property. So valuing intellectual property is a very specialist and difficult task, particularly if you're looking at an intangible that is unique. So if you think about pharmaceutical companies that have blockbuster drugs, it's not obvious if the drug is the only one or the leading one in its field, exactly how to value the intellectual property. And it gets even more complex when you start to think about the intellectual property involved in digital services, which are an increasingly important part of the global economy. And perhaps the last category that has been particularly problematic for tax administrations is the payment for services within groups, such as management advice and technical fees. So in a sense, none of this is new because the international system of tax treaties has had rules about the treatment of these transactions, and domestic law has addressed some of the risks for many, many years. So sometimes it's possible to make adjustments on the basis of the sorts of rules that we've already heard described this morning, such as if you pay another entity for services which are not actually provided, then that's probably not a necessary expense of your business. And indeed, you may even argue that it's a disguised distribution of profit. More generally, countries have relied on the arm's length principle as elaborated in the OECD's transfer pricing guidelines and recognized in and enshrined in international treaties to ensure the fair distribution of taxing rights between states. But those rules had not kept pace with the way that modern multinationals operate. And so what we saw in response was the first BEPS project. So if we go to the next slide, I'm not going to go through all of the detail of the BEPS program. There were 15 actions that were completed in the end, and they're a complicated and interrelated set of measures. But in terms of intergroup payments, certain specific new rules were brought in. There had been an increasing use of what were known as hybrid mismatch arrangements to exploit differences in the rules in different countries. So you'd set up a transaction in such a way that the payment in one territory was a deductible expense, but the corresponding receipt in the other territory was a non-taxable item of income. These were often some form of derivative financial instrument. So the new rules effectively cancel that advantage and are supported by improved defenses in international tax treaties, which are being implemented through the multilateral instrument, which is enabling the whole network of treaties to be updated by signatory states to that multilateral agreement. And the other major change was an overhaul, a significant overhaul of the transfer pricing guidelines, which were designed to ensure that profits are recognized where the activities giving rise to those profits are actually taking place. So where the substance is, where the people and the assets giving rise to the profits ultimately, where they are located. And that involved tackling the issue of exactly how to deal with those intellectual property payments that I mentioned were problematic before. Interest was the subject of a specific action, and the result was a proposal of that there should be an overall cap on the amount that can be deducted, expressed as a percentage of earnings before income tax depreciation and amortization. Generally, a cap between 20 to 30% of that amount. And that's all interest, because there was a recognition that one of the problems countries faced trying to restrict interest by reference to the arm's length principle was that the very fact that interest is tax deductible and dividends are not had led to an increase in the use of debt generally in the funding of businesses. And that's problematic, not just from a tax point of view, but also because it increases the extent to which large corporations are vulnerable in crises. And we saw this in 2008, and we're seeing it again in the current crisis. And so policymakers were concerned that excess debt was being driven by the tax advantages of debt, and that was making firms unnecessarily fragile. So that's been actually quite a big success. We've seen the European Union applying the interest cap across all of its member states. And out of 134 jurisdictions that are participants in the inclusive framework, 67 have some form of interest limitation. Not all of them adopt the EBITDA cap. Australia still, for example, relies on thin cap approach, which is a variant of the arm's length principle. But I think many states see the advantage of a more mechanical rule. However, what became clear was that jurisdictions and policymakers were not satisfied that that they had fully addressed all of the risks for base erosion and profit shifting. And there were two elements to that. One was the feeling that the very big tech giants were still able to participate in an economy, but without having any physical presence there, and generate significant profits, which people felt were being partly created in their states, but under traditional rules, they had no basis for asserting taxing rights. So this was the problem of scale without mass. But although that commanded a lot of the headlines and continues to be a source of significant controversy, because as you will be aware, the United States has resisted attempts by other states to tax its digital businesses under new rules. There was also a feeling that multinationals still had the possibility to allocate excess profits to low taxed entities. So people were casting around for a policy approach that could bring some of that into taxation, and perhaps place a floor below which countries would not drive their corporate income tax rate. And when that originally appeared as Pillar 2 of the BEPS 2.0, as it's tended to be referred to, it seemed that there was likely to be a balance of measures between those that gave extra taxing rights to the jurisdiction in which the group's parent was resident and increased source taxation. However, now that we see more detail and the Pillar 2 rules have yet to be finalized, that's probably going to happen in terms of the proposals next month, and G20 finance ministers meet later in October to discuss the proposals. However, a draft of the proposals has been in circulation informally, and it's very complicated. 250 pages plus of text, so I'm not going to go into much detail, but just to give you a flavor, what's now clear is that inclusion of low tax income in the profits of the ultimate parent is the primary rule. And taxation at a lower level, by way of taxation of under-tax payments, the under-tax payment rule, that's just a backstop. So what that means is that the main effect will be to increase the tax base of those countries where multinationals are based, and that's likely to be the large countries in Europe, China, and the United States. And furthermore, the scope is limited to those groups that are subject to country-by-country reporting. So that's a relatively small number of groups that make more than 750 million euros in consolidated group revenue. Finally, this will apply when a jurisdiction taxes its local profits at less than an agreed minimum rate. So what that rate will be, it's unclear, but it's intriguing to notice that the examples in the proposal use, for illustrative purposes, a rate of 12.5%. Elsewhere, the United Nations has been pursuing a slightly different approach, which has been to try and increase the taxing rights of source countries. So in 2017, they published a revised model UN double taxation convention, which included a specific provision allowing withholding taxes on payments of fees for technical services. I have to say that the definition of what a technical service is not unproblematic. The UN has also proposed a further new article to try and give source countries taxing rights over the businesses of digital companies that don't have a presence, their approach to the issue of scale without mass. And finally, I and a colleague last year published a slightly different version of an income inclusion rule, which would allocate the taxing rights between all jurisdictions within which a multinational operates, rather than just giving those taxing rights to the ultimate parent, which is likely to only benefit capital importing countries indirectly, if at all. Anyway, so I'll close with that. That's just to give you a quick sort of overview of what's been happening internationally in relation to intergroup payments. Thanks.